Let me know in the comment section down below if you remember what it was like during the 2008-2009 global financial crisis, because I still remember it like it was yesterday. And here we are in March of 2023, another major bank just failed, and the regulators had to step in. You've been hearing about the FDIC, which stands for Federal Deposit Insurance Corporation, that can insure up to $250,000 per depositor. But what does that really mean? And what should you do as a regular working American if your bank ever fails? And why didn't all those people who lost money with FTX, BlockFi, and Voyager Digital get their money back? And what about your investment accounts like the 401k, Roth IRA, and taxable brokerage account? Now, how are they insured if a brokerage firm ever fails? The first one I'll get into is the FDIC insurance and how it generally works. It was created by the Banking Act of 1935 to reassure the American people that their money would be safe if their banks ever fail again, like the Great Depression did in the 1930s. And I'm also going to get into what the FDIC does not protect in a little bit, but the FDIC insurance guarantees $250,000 for each individual or depositor at each FDIC insured institution. And I've said this in many of my videos that when you open an account with any bank, you need to make sure that the bank is FDIC insured. And it'll say it in the fine print when you open an account. And it covers your checking account, savings account, money market account, and certificates of deposits or CDs. But you need to keep in mind that the FDIC insures per depositor and not per account. For example, if I had separate savings accounts with one bank and a total deposit of $300,000, the FDIC insurance still only covers $250,000 out of the $300,000 I have deposited, no matter how many accounts I have. That includes both principal and interest. The safest bet is to keep my account with the bank under the $250,000 threshold. Again, the standard FDIC insurance amount is $250,000 per depositor per insured bank for each account ownership category. You also need to make sure that the accounts you hold are in the same banking institution and separated by branch or affiliate. And speaking of the ownership category, this screenshot is directly from the FDIC website. If you have a joint checking or a savings account with someone else, you can be insured for up to $500,000. You would basically need to divide every account by 50% and make sure that it doesn't exceed $250,000 per limit per person. For example, if my wife and I had a $350,000 CD and a $150,000 savings account at the same insured bank, the two accounts will be added together and insure for up to $500,000 or $250,000 in insurance coverage for each co-owner. In some retirement accounts like IRAs, solo 401k, tax-deferred pensions, and 457 deferred compensation plans are insured by the FDIC. Just keep in mind that if you have all of those retirement accounts with the same bank, your FDIC coverage limit is still up to $250,000 with all of those retirement accounts added together. And you can also open a bank account with a different entity like a trust or business. So, for example, I have a personal checking account and a business checking account. Because my personal checking is under my name and my business checking account is under Fireside Chat Limited Liability Company, each of those accounts is insured up to $250,000. And I can do the same thing with having multiple trusts because they're treated as separate entities or, for lack of a better term, a separate person. So basically, it's insured up to $250,000 per beneficiary on that trust. What the FDIC insurance doesn't cover is your life insurance policies, stock and bond investments like mutual funds or ETFs, crypto assets, annuities, safe deposit boxes and their content, and U.S. Treasury securities. And I'll get into how the SIPC insurance coverage works after you download my financial independence resources for absolutely free by visiting firesidechat.com/contact. You should also check out my Fireside Chat shop to check out the books and equipment I use at firesidechat.com/shopping. And the SIPC, or Securities Investor Protection Corporation, is the one that protects depositors if their brokerage firm ever fails. FDIC insures the banks while SIPC insures brokers. Now, the likelihood of a brokerage firm failing is slim, but it's happened in the past. This is why it's important to understand the differences between FDIC and SIPC coverages for your investment assets. Sometimes both FDIC and SIPC could step in to give you the maximum protection. For example, if you have $250,000 in CDs and $500,000 in investments with a 401k, if your brokerage firm goes bankrupt, the FDIC could cover your CD for up to $250,000 and your 401k investments for up to $500,000. That makes sense so far, right? And these investment assets include cash, stocks, bonds, mutual funds, treasury securities, and certificate deposits with the registered brokerage firm. The SIPC coverage is higher than the FDIC coverage at $500,000 per customer, which includes a maximum of $250,000 of cash coverage. The key word is registered. You want to make sure that you're not investing with an unregistered brokerage firm like Bernie Madoff and his Ponzi scheme, right? And what happens essentially is that if your investment broker goes bankrupt or files for liquidation, the regulators will step in and move all of your money to another registered brokerage firm. And if you scroll all the way to the bottom of the brokerage page, you'll see that the brokerage firm has the published SIPC membership disclosure PDF. And if you can't find that, it's probably best that you find a new brokerage firm. Also keep in mind that SIPC insurance does not cover bad investment advice. So if your brokerage firm had you invest in a mutual fund that performed at a total loss or partial loss at 50, 60, or 70%, you'll need to file your complaint with FINRA, the SEC, and the state regulators. The SIPC insurance will not pay you the investment losses because it only helps you if your brokerage firm goes under. If you made a bad investment decision and invested in something that is now worthless, you can't get the money from SIPC. And speaking of bad decisions, when FTX and BlockFi went bankrupt, their customers who had cryptocurrencies with those brokers were not covered by FDIC or SIPC. And we've all known this for a long time, and I've covered it on this channel in the past. If you're keeping your cryptos in a cold storage wallet and not with a crypto brokerage firm, the chances are that your assets are much safer. If you go to the SIPC website, you're not going to find any crypto exchanges on their list. The only exception was a brokerage firm like Robinhood, which allows you to trade both stocks and crypto. And that's probably why they made it to the SIPC list. But does this mean I'm going to limit my investment accounts to just $500,000 per brokerage firm? No, that would be ridiculous, right? But I chose to invest my retirement and non-retirement accounts with large firms that are considered too big to fail. Investing with big firms like, let's say, Charles Schwab, Fidelity, Vanguard, or E-Trade gives me a little bit more comfort that if they ever fail, the Fed and Treasury will most likely intervene and help out the depositors. Vanguard has $8 trillion in assets under management. Schwab has $6 trillion. Fidelity has $3.6 trillion. And JP Morgan has $2.6 trillion in under assets management. If these brokerage firms ever go under, not only are we going to be in very serious financial trouble as a country, but the probability of the government stepping in to help customers get their money back is really high. Oh, and by the way, if you're interested in joining my private individual, couple, or group sessions, or my private Facebook group, you can sign up on my main YouTube page or by visiting firesidechat.com/coaching to discuss your financial independence journey. By the time I publish this video, we're already seeing 3 banks collapse in just 5 days. And I wouldn't be surprised if there are more banks other than Silvergate Bank, Silicon Valley Bank, and Signature Bank starting to fail in the coming months. Is this the repeat of the 2008-2009 global financial crisis? I can never say for sure, but the probability of that happening is higher than it was ever before. And I'm not trying to instill fear, uncertainty, or doubt, FUD, in you right now, right? But I want you to be fully prepared if your bank fails and the regulators come in and do a hostile takeover. First, you need to take a look and write down every single bank and investment account on the spreadsheet or Word document so you can keep track of them. Most Americans don't have more than $250,000 in cash or CD savings in their accounts, but most of them could exceed that amount in their investment accounts. You now know how FDIC insurance works with a limit of $250,000 per depositor. If you have more than $250,000 in cash or cash equivalent assets, you can explore other options to keep it covered under the FDIC. You also have the option to open a trust or an IRA, which falls under FDIC coverage. Second, if you have a joint account, you need to have a discussion with your partner or spouse to make sure that your assets are protected under FDIC and the course of action you both need to take in case the bank collapses. Keep in mind that the FDIC assigns 50% ownership to each person in the joint account, which I talked about in the first chapter of this video. Third, you need to write down which accounts have automatic payments coming out to pay your expenses. When the bank fails, it's very likely that you're going to be issued a new account number, but there's also going to be a chance that you get to keep the same account. No one knows for sure until the process begins to take place. What could happen is a gap between the bank transition that will pause all your deposits and withdrawals until the FDIC completes the transition. So it's a good idea to have your cash in more than 2 different banking institutions so that you have access to your liquidity. Remember, the failed bank's assets will be frozen by the FDIC, so automatic payment requests might not take place. You want to make sure your bills don't get late payments. If this is going to be a long-term issue, you need to contact your recipients to figure out a different solution. It is your individual responsibility to make sure the bills get paid. Fourth, if another bank bails out the failed bank, they will contact you with the new account information. You're going to need to order new checks, debit cards, or anything else you need to pay for your expenses, because a bank failure is considered a unique situation. FDIC should pay the depositors back their money within 2 to 3 business days. And lastly, I encourage you to keep up with current events as many things start to unfold in the news. You don't want to be blindsided if your bank fails and you hear about it from your neighbor, right? You shouldn't wait until you have a recession, stock market crash, or high unemployment to improve your financial education, like learning something new from this video, hopefully. And when you're working to achieve your financial independence so that you can retire early, these are the unexpected catalysts you need to account for. No one can ever accurately predict bank failures, recessions, or bear markets, but you can get one step ahead by understanding the process so that you can do everything you can to protect the assets you've worked very hard for you and your family. And if you want to know more about how to diversify your net worth to achieve financial independence, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.